Welcome to MF Global Managed Futures. This presentation is being recorded on September 14, 2011. Today's presenter will be Howard Bernstein for HB Capital Management. Futures trading involves the substantial risk of loss and is not suitable for every investor. Past performance is not necessarily indicative of future results. Please consult the CTA's respective disclosure document for program details, including performance, risks, fees, and drawdowns.
Thank you, MF Global, for having me here today. My name is Howard Bernstein, president of HB Capital Management. We've been trading commodities for 25 years. The risk of loss in trading commodities can be substantial. You should therefore consider whether such trading is suitable for you in light of your financial condition. The high degree of leverage that is often obtainable in commodity trading can work against you as well as for you. The use of leverage can lead to large losses as well as gains. Option buying risk is limited to the full purchase price of the contract. An option seller theoretically has unlimited risk due to the possibility of the underlying asset price changing as a result of significant adverse market movements. Although the premium received by the seller is fixed, the seller may sustain a loss well in excess of that amount. Please see the disclosure document at HB Capital Management for more complete information about our investment program. This presentation is not an offer to sell or buy an interest in any investment product. This investor presentation does not constitute an offer to sell or the solicitation of an offer to buy any interest in any investment product. Such offer or solicitation may only be made by means of delivery of a disclosure document which contains a description of the material terms, including risk factors, fees, and charges, and tax implications relating to such investment product. I wanted to discuss a little bit about the benefit of managed futures. Unlike where the stock market, where in most cases you can only benefit if the stock market goes up, with managed futures you can profit when the market is going down or going up or even sideways, because a lot of traders can go long or short a market, so you can benefit if it goes down as well as going up. We generally trade dozens of different commodity, currency markets, and even stock indices. So you don't have to be dependent on one market, the stock market, to make all your money. And because of the many markets you can trade, there's no correlation between managed futures returns and stock and bond returns. Thus, it reduces the client's overall portfolio volatility. And a few additional benefits, especially in light of all the problems with Bernie Madoff and his fund, is that the futures account is an individual account held in the client's name. It's not in the name of a fund or a pool or a limited partnership. And you also have the transparency where you're able to see not only your account positions, but the value of your account every day as you receive a daily statement. So this gives an investor peace of mind. This is a slide showing performance of the average managed futures account from 1985 to the present in yellow, and the stock market in red. And because of the non-correlation of managed futures returns to the stock market, you can see in years where the stock market was down, managed futures returns, as on an average, tended to be up. So using managed futures in one's overall portfolio could potentially help to mitigate the volatility in the stock market. Our particular strategy is we buy and sell options on different futures contracts. So we look to find the best option strategy for each market. So we start with a top-down approach where we look at where the market might be going directionally, and then we build the best option strategy for that move. And then we may look at sentiment readings to help us look for turning points in markets, and as well as especially in the grain markets such as corn, wheat, and soybeans, we'll use seasonality and other factors in timing our trades. This schematic shows the option time decay curve. As you get closer and closer to E, which is the expiration date of an option, the option decays at a faster and faster rate. So using this curve, we can build option strategies such that we sell options that decay at a very fast rate and buy options that decay at a slow rate. On these next few slides, I will give examples of some of the types of option strategies that we put together along with some chart examples so you can see what it looks like. In a vertical, you buy one call and sell another call in the same month, and if you on a bull call you're looking for the market to go up. On a bear spread you're looking for the market to go down. So this is a directional trade. Gains and losses are capped, meaning you can only make a certain amount of money, you can only lose a certain amount of money. In this example of a bull vertical trade, we bought a sugar May 28 call and we sold a May 30 call, expecting a rise in sugar. And the further sugar goes up, the more money we make, until a maximum of about $1,100 on the trade. On the other hand, if sugar goes down, we could lose the same amount. So this trade you would put on, you're expecting the market to go up. In a calendar spread, you buy a call or a put in one month and you sell a call or a put in a different month. This can take advantage of the faster time decay in the near month, or as some cases there's a volatility differential between months, and we try to take advantage of that as well. Let me now show you a chart example of a calendar spread. In this example of a calendar spread in sugar, we sold a May 30 call and bought a July 30 call. So we try to take advantage of the faster time decay in the May option as opposed to the July option that we bought. And the chart shows potentially a wide range of profitability irregardless of where the price is for sugar. The final example of an option spread that we use is called a ratio spread, where you buy one option and then you sell two options against it. So whereas in the other strategies you were buying one and selling one, this one you're buying one and selling two, or in some cases buying one and selling three. So it's usually a directional trade, and you can have unlimited risk, however, if you are selling the two options for one that you buy. This ratio spread example is from the soybean market, where you buy one soybean call and then sell two out of the money calls against it. And you can profit potentially on a move up in the soybeans unless soybeans go up too quickly, and then you can lose. On the downside, your risk is limited, as you can see on the left-hand side of the chart. This is a chart of soybean volatilities, and you can see these four spike highs on the chart. They represent approximately June or July, when the soybean volatility is the highest. The volatility tends to be in the highest during that period because the soybean crop has been planted, it's growing, traders are not sure if there's enough rain or enough heat, whether you're going to have a good crop, so volatility tends to be high. So we like to take advantage of this by selling high volatility. Continuing on with soybeans, the seasonal pattern in soybeans tends to go up until June or July, once again as they build weather premium into the soybean market as they're unsure about the crop. And then once the crop is made, soybeans then tend to fall from July all the way down to the seasonal low around the 1st of October. So once again, we can build option strategies to potentially take advantage of this seasonal pattern. This chart from 2009 shows a textbook move up in soybeans as it peaked during its normal seasonal time in June and then declined into the seasonal low at the end of September. Silver and gold tend to be good markets to look at extreme sentiment readings, and on this chart you can see places marked where you had high percentage of bulls or bears, and it tended to be at turning points in the silver market. We can use this information to then build option strategies to take advantage of potential reversals in the market. Not only do you get high sentiment readings at turning points in silver, but you also get times where the volatility skews to the call side, meaning that the calls get very expensive as people are willing to pay big money for a way out of the money call option in the market after it's gone way up. So when the public is buying these expensive options, we're looking to sell those options. In summary, we have had 25 years of trading experience in the futures and options market. This program gives us the ability to trade in any market where we see an opportunity. And we don't need a bull market to make money. We can make money if markets are going down or sideways. And both pre-tax and post-tax investment dollars are eligible. Please note that option sellers are subject to margin calls and are exposed to unlimited risk. In our 25 years of trading, here are some of the awards that we have won. To get more information on the performance of our program, please contact Paul Rieger at MF Global Managed Futures at 1-800-273-4899 or prieger@mfglobal.com. Thank you very much.